Hello everybody, we're here today at the Kaplan Business School. I'm joined by Michael Steed, who is the AAT tax guru and accounting technician columnist. Michael, welcome to you. Now to the issue of dividends, because a couple of high profile court cases have come to the fore which have led to worries over systems which pay people through dividends. Michael, how worried are you about the implications of these cases?
I'm perhaps not as worried, Ben, as some people are. I'm moderately pragmatic about that, and certainly I'd like to make a distinction, as a general distinction now, between people paying dividends because it's part of their intrinsic setup, and they did that right from the beginning. And of course the leading case there, and is well-established law now, is Arctic Systems Limited, where you had a sort of an IT husband and a sort of a lesser working wife, didn't do quite so much, but they get equal dividends because they got a 50-50 split on that. HMRC hated that, but it went right through to the House of Lords and it settled law, and they've always said they'll come back to it, but they've never quite got there. But these two recent cases, one of which is called PA Holdings and one of which is called Manthorpe Building Services, they're generically concerned, and this is what the taxman's trying to attack, what he perceives to be schemes where you've got sort of more aggressive tax planning. I think generically he's going to go for those sorts of cases. And so if you had, say, a company that had employees where you paid them bonuses, subject of course to tax and NICs, and suddenly you decide to make them a shareholder and pay them dividends instead, that would be the sort of case where HMRC is pretty likely to take up the cudgels again you. So I think that's the first point, but I think what's more relevant is to understand why I'm more pragmatic about that, is to go back a step and look at the scenario where an average AAT member is perhaps advising on to clients if he's a member in practice, or where you've got AAT members that are working for such companies. And I'm here talking about SMEs, tend to be the smaller family companies. So the issue simply is that if you set up in business and you choose to go through a corporate vehicle, no problems with that at all, and you then take a low salary and strip the rest out through dividends, because of the Arctic Systems case, settled law, nobody is going to have a problem with that.
Sure.
I think that's the first and key point. The sort of more, and there's the other thought too, and that's about the general anti-avoidance rule that's coming in 2013. Now, I know you've covered that rather well in your magazine in the last few months, but if I could just add in a bit of weight to that, and that is to recognise that a lot of these sorts of cases, and I'm here still talking generically, are likely to be struck down from 2013 in any event because of the application of the GAR.
Yeah.
Now, in terms of the basic AAT stuff, this kind of really important bread and butter advice that we give, I just don't have a problem, as the law stands at the moment, with paying, I'm just very loosely going to call it personal allowance salary, lowish salary, and then strip the rest out in dividends. These two cases and cases like them notwithstanding. I think that's the key message from me. Where it gets a little bit grayer, again in a family company scenario, is where you say you've got mum and dad in the company, been running it for years, they're now in their 60s, looking to retire, next generation's coming up through. Do you then make, say, the two sons who have formerly been employees, do you suddenly make them shareholders? And if so, how do you do that? Do you gift them shares? Do you issue new shares? Now that is very much an AAT type of question. And when I'm on the tax update series, I try and come back to those so that we're constantly raking it, giving it a little bit of an airing, because it is so important. So that whole issue about getting a second generation, maybe through the mechanism of what's known as alphabet shares, where mum and dad have got the A shares and the sons, in my example there, have got the B shares. But it is quite, that's a little bit more of a difficult area. I'm just fractionally more nervous about that, but the sort of very artificial schemes, these generic schemes that HMRC are attacking, I see those as being very distinctly different from the sort of the bread and butter, and within the context of the GAR, acceptable tax planning within the context of a very, very complicated tax canon that we have in the UK.